Sell in May and go away. It's one of the oldest sayings in investing, but does it still make sense in 2025? Let's look into the data I have here and what has been happening to understand why this year might be the exception, and why selling in May could be a costly mistake. I know you all remember this and probably will say, didn't you just say, remind me to sell in May in this tweet here? Yes, hold on. I'm going to walk you through exactly why I said that and what my thoughts are for 2025. So, if this sounds good to you, let's get the show on the road. Alright, quick question for you guys. Have you ever heard the saying, sell in May and go away? Well, here's why people keep repeating it. If you go back all the way from 1950 to 2023, the Dow Jones barely moved between May and October. I'm talking about an average return of just 0.8%, and this means it was basically flat. Now compare that to the other half of the year from November to April, where it averaged 7.2%. Big difference, right? And if we zoom in a little closer, looking at the S&P 500 from 1990 to 2024, same story. May to October, just 3% average returns. November to April, more than double that, 6.3%. So yeah, historically the market's been kind of lazy during the summer months, but is 2025 going to follow the same pattern, or are we in a completely different setup? Here is the question we really need to ask. There is also a wealth simulation that shows if you invested $100 in the S&P 500 from 1990 to 2024, it would have grown to $1,550. While if you invested them only in the winter months, which is from November till April, you would have grown them to $800. And if you invested them only during summer, which is from May till October, you would have grown them to $250. This confirms that full year investing far outperforms summer only and winter only strategies, and that most returns historically come from the winter months. Let me throw another stat at you that might surprise you. You know what month has historically been the worst for the stock market? September. Yep. Since 1928, the S&P 500 has dropped in September more often than any other month. Not October, not June, not even the spooky Halloween crashes. It's September that usually does the damage. Now, why is that? Well, a few things happen around that time. Big funds start rebalancing their portfolios. Some investors start to lock in losses for tax reasons. And a lot of people are just adjusting their positions heading into Q4. Basically, September shows up like that one guest who always brings the vibe down at the end of the party. So when we talk about the May-October stretch being weak, September plays a big part in dragging that average down. Which means that September can be the one month that causes you the biggest loss. Alright, but here's where things get interesting. Because while the sell in May idea has held up a lot of the time, it hasn't always worked. In certain years, the market didn't care about seasonality at all, it just took off. Take 2009 for example, right after the financial crisis. From May to October, the S&P didn't just survive, it ripped 18% higher. Then there's 2013, the good old QE era. Markets were flooded with liquidity and the S&P jumped 10% during that same summer stretch. And who could forget 2020? Post-COVID stimulus, trillions pumped into the system. It wasn't just a recovery, it was a full-blown rocket ship. The market surged 17% from May through October that year alone. So what do all those years have in common? What made 2009, 2013, and 2020 different? Three things, and they're big ones. Central banks were easing slashing rates, buying assets, keeping markets afloat. Liquidity was flowing like crazy, and in every case, the market was bouncing back from a major bottom. So yeah, the sell in May pattern, it completely broke down because the macro environment flipped. That's the key here. When the Fed steps in, when money's cheap, when the system gets support, seasonality doesn't stand a chance. Now don't get me wrong, seasonal trends can be useful. They give us signals, patterns, historical context. But here's the thing, they don't tell the whole story anymore. Because markets today, they've changed a lot. First off, retail investors are way more active now. Back in the day, summer was quiet, institutions went on vacation, volume dried up. But now, retail traders are in the game year-round, injecting liquidity, moving markets, and breaking the old patterns. Then you've got algorithmic and passive investing. We're not just talking human traders anymore. So AI models, quant strategies, hedge fund bots, they're out here trading every single day without ever needing a summer break. And let's not forget globalization. The US market doesn't just react to what happens in New York or DC. It's plugged into China, Europe, the Middle East, crypto, Twitter, you name it. It's a 24/7 feedback loop. So when we look at 2025, this isn't some copy-paste of the past. It's dynamic, it's macro-driven, it's global, and it's exactly why those old seasonal rules might not apply anymore. And speaking of 2025, this year is already breaking the old mold. Think about it, just look at what's happening right now. M2 money supply is growing again, which means there's more liquidity in the system. The Fed, they're done hiking for now. Markets are pricing in rate cuts later this year, not more tightening. There's still talk of a soft landing, and believe it or not, investors are starting to actually believe it. Even in crypto, we're seeing strong signs. Spot Bitcoin ETF inflows are picking back up, and institutions haven't backed off. And those geopolitical shocks, the US-China tariff drama, Middle East conflicts, they peaked back in Q1, and we're finally starting to see things cool off a bit. So when you line it all up, this isn't a setup for fear or retreat. It's the kind of environment where staying in the game might actually pay off. And here's what makes this even more interesting. A lot of the biggest risks, we've already been through them before May even started. The US-China tariff escalation, that bomb dropped in Q1. Markets took the hit, absorbed the news, and moved on. The Red Sea conflict and oil supply shocks, same story. That was already priced in by March. And even when inflation picked up again, the Fed didn't panic. Their tone stayed dovish, signaling they're still focused on stability. So if all that already played out, what's left to scare the market this summer? That's the setup we're walking into, and it's way more constructive than most people think. Now here's the thing. Markets might finally have some breathing room to run. At first, rate cuts are probably coming, but not just yet. Poly market odds for a May cut are sitting at just 8%, so the expectations are already super low. No one's banking on May, but the meeting after, that's when things start getting real. If the Fed moves then, it could push more liquidity toward risk on assets. Then there's the US-China trade situation. Right now, tariffs are already sky high. There's not much left to escalate. So, what's the next logical step? Talk. Both countries are economic giants. They do need each other. A move toward negotiations could flip the global sentiment almost overnight. And lastly, geopolitical tension is cooling down. There's still conflict in Ukraine and the Middle East, but markets are adjusting. If things de-escalate even slightly, it's a green light for capital to come back into risk-on trades. Put all of that together, and yeah, this doesn't look like a market you sell in. But let's zoom in for a second. What about Bitcoin? Because if we're being honest, summer hasn't been too kind to BTC either, so check this out. In 2024, Bitcoin dropped around 9% between May and October. In 2023, it slipped 6.5%. 2022 was brutal, down 49% in that same window. Even in 2021, it was down 17% by October, and at one point in July, it was down 50% from May highs, and back in 2018, it fell 27% during the summer stretch. So yeah, it hasn't been pretty. But here's the thing. When BTC does perform well in summer, it's usually not random. It's tied to major macro forces, and that's exactly what we're seeing in 2025. So yes, I really wish I sold in May in all of those years. I would have saved myself a lot. That's why I always want reminded to sell in May, unless it is one of those exceptional years. Now, after listing all those summer drawdowns, you're probably thinking, man, I wish I just sold every May. Yeah, same here. That's why I keep telling myself I need a big red button that just flashes sell every spring. But there were exceptions. And they were big. In 2017, Bitcoin went on a full-on bull cycle rampage. And in 2019 and 2020, it was all about liquidity injections, stimulus checks, and the early adoption wave. Everything was lined up for a breakout. And now here we are in 2025, and honestly, it's starting to feel a little familiar. Liquidity is rising again. Institutional inflows are back in a big way. Bitcoin just completed its halving, which historically kicks off the expansion phase. And we're starting to see altcoin narratives rotate back on-chain, especially around real yield and infrastructure. So yeah, maybe 2025 isn't the year you hit that big red sell button after all. So let's get one thing straight. This isn't a sell and walk away kind of market. It's a rotation market, and especially in crypto. Here's what that looks like. You want to lean into high revenue, high retention protocols, the ones that are actually being used, not just hyped. Stay away from the noise. Tokens with no real users, no fees, and no value behind them aren't going to survive a real cycle then. And watch where capital is flowing. While Bitcoin continues to attract fresh institutional money, we're also seeing rotation into multi-cycle altcoins, projects with strong fundamentals, real use cases, and long-term utility. Your portfolio should reflect all of that. Focus on the infrastructure of crypto. Layer 1's DEXs, perp DEXs, these are the building blocks. They generate fees, they power activity, and they're built to last across multi-cycles. Sell in May is a powerful pattern, but it's not a rule. Yes, seasonality matters. But in 2025, The Fed is dovish, geopolitical risks peaked early, liquidity is rising, Bitcoin is entering a post-halving expansion phase, so the worst may already be behind us. Bottom line, if history rhymes, 2025 could be another exception, just like 2009, 2013, or 2020. So don't go to cash, reallocate, rebalance, find alpha in rotation, not retreat. All right, my friends, I will see you guys again. Until then, trade well, my friends.